Hey guys, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Now, the $1,000,000 question. Should you stay invested in the stock market, or should you keep moving in and out of the stock market based on certain parameters? Now, if you ask a fund manager, he'll of course say that you should stay invested in the stock market because it's in his interest that you stay invested in the stock market and not move into cash, because if you are in cash, he won't earn his fees or he won't earn his salaries. On the other hand, if you are invested in stocks all the time, it works in his favor. And he also gives a very sound logic to it. Last 30 years, if you would have missed the 25 best days in the stock market, your returns would have fallen dramatically. Last 30 years, Sensex is up around 38-40 times. However, if you would have missed the 25 best days in the stock market, only 25 days, 30 years has around 5,500 to 6,000 trading days. And out of that, if you would have missed only 25 best trading days, your returns, start to finish, would have fallen from 40 times to just 5 times. Yes, that's right. The way the stock market works, only a small number of days account for a large percentage of gains of the overall stock market. And if you are missing those big days, your returns would be a fraction of buy and hold. And this, I think, is a sound logic. However, I would suggest that you don't stay invested in the stock market all the time. You move in and out of the stock market and try to take advantage of its tendency to speculate and its tendency to, commit errors when it comes to valuing stocks. Now, why I say this? Fund managers, people, whose incentive it is to make you stay invested in the stock market all throughout, they don't give you another side of the story. The another side of the story is that last 30 years, what would have happened if you would have missed 25 worst days in the stock market? Again, last 30 years, Sensex is up some 38-40 times. If you would have missed 25 worst days in the stock market, your returns would have been a whopping 300 times. Of course, this number sound unbelievable to me as well. That's why I did the calculation a few times over, and every time the same conclusion. Your overall corpus would have multiplied a whopping 300 times if you would have missed the 25 worst days in the stock market. Now, it is because of this huge difference I'm in favor of moving in and out of the stock market, provided you're able to avoid some big crashes, some big declines. If you are able to avoid big declines in the stock market, if you're able to sidestep a few big crashes, you should definitely, try and move in and out of the stock market and take advantage of the underlying tendency of people to speculate. How do you do this? Of course, theoretically, it sounds very good to say that you should miss the 25 worst days in the stock market, but it's practically impossible, right? Unless you have divine intervention, you will not know on which of those days there's going to be a big crash. So it's practically impossible. You will need another method. And I have one such method in mind. Now, what I've done is 2001 to 2020, I have looked at the average PE multiple of the Sensex. The average PE multiple that the Sensex has traded last 20 years. That number is around 19-20 times. Of course, because of the inherent tendency of investors to, speculate and be very, very greedy and, also be very fearful at times, the P multiple hasn't remained at 20. At times, it has gone way above 20, and at times it has gone significantly below 20. So what I did was, it's easy to determine that when the Sensex PE moves significantly away from 20, goes significantly higher by 20, the possibility of a crash increases. If Sensex goes to price to earnings multiple of 25, 26 times, what I did was I moved 75% of the corpus to fixed deposits and kept only 25% in stocks. So 31st December every year, I looked at the price to earnings multiple of the Sensex. If it was greater than 25 times, I was only 25% in stocks and 75% in fixed deposits. Fixed deposits, I assumed a rate of 7% for all the 20 years. And I kept the corpus this way for the next 1 year. After 12 months, same thing. Take a look at the Sensex price to earnings ratio. If it's more than 25 times, only 25% in stocks, remaining in fixed deposits. If it's less than 25 times, be 100% in stocks and nothing in fixed deposits. 20 years, Sensex is up 12 times. This strategy is up 22 times. Small tweak has led to you earning a corpus which is almost twice as good as what the Sensex has given. Now, why this has happened? This has happened because by staying in cash when the Sensex is more than 25 times, you have sidestepped some of the big crashes that have happened in the stock market over the last 20 years. And because you have sidestepped and you have avoided a big decline in the stock market, your corpus has gone on to give fabulous long-term returns and it has gone on to outperform the benchmark index. Now, I am using this strategy for one of my services, Microcap Millionaires, and the results have been pretty encouraging. Since 2014, the corpus, the Microcap Millionaires corpus is up. It has given a CAGR of 21%. Sensex has given a CAGR of 13-14%. And what I do the same thing. Once every 6 months, 12 months, I look at the Sensex PE ratio. If it's more than 24-25 times, I minimize the exposure to stocks. And if it's less than, significantly less than 20, 22, 23 times, I maximize my exposure to stocks. And this rule has played a very important role in me being able to, outperform the benchmark index. Now, of course, you would say that this entire formula is dependent on that, is, heavily reliant upon that 25 PE number. What if the PE multiple changes in the future? What if the average PE is not 20 anymore, but it becomes 25 times, 26 times, and the market does not fall significantly below 25 times? In that case, what do you do? Fair enough. Another way of doing this, if you have 100 rupees, put 50 in fixed deposits, put 50 in stocks. Stocks becomes 55%, reduce the allocation and, put the money into fixed deposits, make that 50-50 again. Fixed deposits becomes, market goes down. Fixed deposit becomes 55%, put the money back into stocks and keep doing this. And I'm sure you'll not get a bad result out of your investment. In fact, everything going well over a long-term period, you may end up outperforming the benchmark index. And this 50-50, every once in a while, if you're very confident of the stock market and if you think the stock market is looking very attractive from a long-term perspective, right, like it happened in March 2020, then you may not keep 50-50. You may keep 75-25. If you're very confident of the future of the stock market and you feel that it's very attractive from a long-term perspective, have the stock allocation to 75% and only 25% to fixed deposits and let it run for a year, year and a half, and then again, rebalance it to 50-50 or 75-25. But according to me, never be 100% invested in stocks all the time. If you have any shot of outperforming the benchmark index, you'll have to do things differently than what the crowd is doing. If the crowd is being 100% invested in stocks all the time, you'll have to do things a little differently. You'll have to take advantages of the undervaluation, the overvaluation that keeps happening in the stock market from time to time. And it may perhaps be your best chance at outperforming the stock market index. So let me know, in fact, what do you think of the strategy, whether it makes sense or not. As usual, I'll be looking forward to your comments, your likes, dislikes. So do keep them coming. and I'll see you again next time. Thank you so much.